Hey folks, it's Kevin. In this video, we're going to be talking about how you can know if you're pre-approved for a home loan without talking to a lender. After watching this video, you'll understand your position and whether you'll get pre-approved, and also you're going to learn about debt to income ratios, credit scores, and how much money you actually need to bring to the closing table in order to get a new home. Let's jump right into it. So the first thing that you're going to want to understand is your income monthly. Second thing is your debts. And what I mean by debts is your car loans, credit cards, student loans, and the minimum monthly payment associated to those. So not necessarily your total balance of debt, but how much you actually have to pay on a monthly basis. So what you're going to do is you're going to add up all of those minimum monthly payments. And let's say your minimum monthly payment is $1,000 a month. What you're going to do is you're going to add in your estimated mortgage monthly payment. And let's say you're buying a $500,000 home and your monthly payment is going to be $3,000. You're going to add $3,000 to the $1,000 of monthly debts that you have, and you're going to get $4,000. $4,000 divided by $10,000 is going to be 40%. Now with an FHA loan, which is a common first-time homebuyer loan, they're going to allow you to use up to 55%. Which means that you're going to have a lot of purchasing power in that scenario for a $500,000 home. Now, if you want a bigger home, then obviously that's going to increase the monthly payment, and that monthly payment is going to ultimately cut into that income and ultimately that debt to income ratio. So I hope that helps. The second component is going to be your credit score. Where does your credit score need to be? And then where do you want your credit score to be to ultimately get the best interest rate possible? So for an FHA loan, the minimum credit requirement is going to be 620 FICO score. Now, I understand that some lenders can go down to 580 and some down to even 500, but you really want to get your credit to a 620, so that way you're not going to be offered a terrible interest rate and it's going to be more affordable when you go to purchase your home. Now, I know that we're all in this race of getting our credit scores as high as they can get to, and ultimately it's a game. When you pay down your credit, when you pay off your credit, or when you run those credit cards up, it can have an influence on your credit score, and that can change daily. So where you're going to want your credit score to be in order to get the best interest rate possible is going to be a 740 credit score. If you have a 760, a 780, an 800, it's not going to influence the interest rate. 740 is the top tier of credit qualifying when purchasing a home. So if you have a 740 or greater, just know that you're going to get the best interest rate offered to you. And the third component in all of this is going to be the closing costs, or I should say the cash to close, because that's made up of a down payment and the closing costs. So let's get right into it. The down payment on an FHA loan is 3.5%. The minimum down payment on a conventional loan is going to be 3%. What's the difference between conventional and FHA? An FHA loan is backed by the federal government, which allows them to be a little bit more lenient in their guidelines. Yes, you're going to be paying 0.5% more in down payment. However, you'll find that the interest rates offered are better. And secondly, they're going to allow you to purchase more home because the debt to income ratio on an FHA loan is 55% in comparison to conventional, which traditionally is about 45%. Going back to the cash to close. For down payment requirements on a conventional loan, you're going to need a minimum of 3%, unless the purchase price of the home exceeds about $530,000. In that case, you're going to have to bring in a minimum of 5% down if you were to go with a conventional loan. And for FHA loans, you're going to be paying 3.5% regardless of where that purchase price is. Now that we've talked about down payment, what other things go into the makeup of what cash you need to bring to the table in order to close? That is the closing costs. Now, closing costs are made up of a few things, but the majority of your closing costs go to pay for prepaid taxes and insurance 6 months in advance. So you have a tax rate that is associated to wherever you're purchasing your home. Here in San Diego, it's about 1.25%. So if you're purchasing a $500,000 home, you're looking at about $520 a month. So they're going to collect 6 months of that amount up front. So that way you're prepaid, and every month that you make your monthly payment, you're always 6 months ahead. Now, the other things that your closing costs are made up of are going to be escrow and title fees. The escrow company is basically a third-party referee where they make sure that the buyers and the sellers are playing fair. They hold all of the money throughout the duration of the escrow period. And then once you go to close, they make sure that the sellers are paid and that the buyers get to fund and make their home theirs. Now, title, a little bit different. Title insurance, what they do is they make sure that the sellers don't have any existing liens that would prevent them from selling, like tax liens, solar liens, things of that nature, and that buyers are in fact who they say they are and nobody's fraudulently purchasing a home in your name. And so there are costs associated to those title and escrow services. Now there are all sorts of additional fees that I'll go ahead and add up here so you can see the full breakdown, but on average, closing costs are going to be about 2%. They can be higher, they can be lower, depending on what the purchase price is of the home, yet on average, you're going to see about 2%. So we're talking about anywhere, including a down payment, from 5% to 7% on the lower side. If you're looking to bring in a minimum down payment of anywhere from 3 to 5%, then you're going to be talking about 5 to 7% once you add in those closing costs. So that's about what you can expect when figuring out how much money you need to bring to the table. We just covered what your income is in regards to your debt, in addition to what your proposed monthly payment's going to be, where your credit score needs to be, and lastly, how much money you're actually going to need to bring in. I hope this video was of help. If you guys have any questions, please leave a comment below, like, subscribe this video. As you can tell, my YouTube channel is just getting started, but I intend on continuing to make videos much like this one, covering different topics. I am a real estate agent and a real estate coach here in San Diego in the Chula Vista area, which is in the South Bay. So I hope that you can follow along my journey, and I hope that you got value from this video. Thank you for tuning in. I'll talk to you soon.